Welcome all to the Unit 2 Life Insurance. In the previous sessions, we discussed on the Unit 1 Risk and Insurance. In that, we saw various concepts like meaning of risk, characteristics of risk, method of treating risk, meaning of insurance, definition of insurance, features of insurance and functions of insurance in a detailed manner. How life insurance powered the individual and family. Let us see. If you are one of those people who believe that insurance is good only for saving tax, you are far from the truth. Insurance can serve as a piggy bank where you can buy a variety of insurance policies to save the money lifelong. Think of it like the fire extinguisher you are required to keep in your home or office. Perhaps you may never have to use it, but when an actual need arises, you are so glad it is in your hand. In the same way, if you have unpredictable expenses such as car repairs or medical bills cropping up, insurance can become a financial lifesaver. There is no way you can avoid the unexpected tragedies of life, and of these, death is the most unexpected. If your family is financially dependent on you, the head of the family, you would need to make sure there is enough financial security for your loved ones even after you are gone. Whether it is paying for household expenses, securing your offspring's future, or making sure your parent or spouse gets the much needed financial support to maintain their standard of living. Life insurance can help compensate for the inevitable financial consequences where you are no more. Life insurance can also help your loved ones repay any outstanding debts or mortgages you left behind. You may perhaps believe that you can save enough money to replace your assets should anything happen to you. However, considering the uncertainties that life is all about, have you ever asked yourself the question, what if something happened to me? Will I be able to provide a financially secured life for my loved ones? We will see the real time example of Mr. Ganesh, a professional from Chennai. Life insurance has always been an integral part of his overall financial plan. He attributes this to his father, who, despite being a man with a disciplined approach to saving, he would always advise his children to save for a rainy day. Understood that insurance was imperative to cover his loved ones from risk. Ganesh reveals how his father opted for a life insurance policy early in his life after calculating the finance the family would need if something were to happen to him, taking into account things like living expenses. He did not know it at the time, but making life insurance a part of his family's financial blueprint would turn out to be the smartest financial decision he would ever make. Ganesh and his brother were of school going age when their father passed away. How did the family deal with the uncertain times ahead? Ganesh admits that they were afraid that the money would dry up, but reveals that thankfully the settlement from his father's life insurance policy saved the day. So, we will move into the introduction part. There is only one breadwinner in most of the families in our country. From dawn to dusk, he strains every nerve to earn his livelihood. He is supposed to face two types of death in his life, that is, physical death and economic death. Physical death refers to untimely and sudden demise of breadwinner of the family. If he dies too soon, all avenues of income are closed to his family. In the absence of an adequate financial backup, his children are deprived of proper education, nourishment and other avenues of life, leading to a stunted growth. On the contrary, if he lives too long, even after his retirement from service, he will have to face economic death. He finds it very difficult to manage day-to-day expenses of his family with his meager pension amount. As he fails to fulfill the needs of all his family members satisfactorily, he will become financially dead. In both the cases, that is dying too soon or living too long, the ultimate and worst financial sufferers would be his family members. Then, what is the remedy for this type of problem? Who will come forward to redress the grievances of his family members? Probably, life insurance is the only solution available to the breadwinner of each and every family to save his family members from financial problem which is likely to arise after his death or at his old age. How long insurance is existing in the world? Let us see the origin of life insurance. In England, the concept of insurance emerged in 16th century. Richard Martin issued the first policy on William Gibbon's life in the year 1536. The G. Gibbons policy gave great publicity to life insurance. Later, two companies by the names Hand in Hand Society and the Emrc Company came into existence in the year 1696 and 1698 respectively. The Society of Assurance for Widows and Orphans was started by Stainsfield in 1699. In 1719, the business of life insurance was undertaken in joint stock form. Then, in 1721, Parliament passed an act which allowed the promotion of companies with the object of life insurance business. So many big companies came up in Britain like the Royal Exchange Assurance, British Insurance Company, etc. But the rate of growth was very slow in USA because of wide fluctuations in death rates. What about the picture of life insurance in India? In India, the historical beginning of insurance is not exactly known. The ancient Indian writers like Manu Yajnavalkya mention about ancient forms of insurance. But the modern concept of insurance came into existence with the East Indian Company in 18th century. So many insurance companies from Britain started coming to India to insure the English residents. They used to charge very high rate of premium due to high mortality rate in India. In India, the first foreign company which started the insurance business was Oriental Company in the year 1818. In 1823, a company named Bombay Life started giving insurance policies for 2-3 year terms. Then Madras Equitable Company came into existence in 1829. These companies failed due to improper and wrong policies in regard to valuation, management and depreciation norms, etc. After that, so many developments took place. Many European companies tried to establish business in India, but failed to survive due to unethical business practices. The British Parliament passed an Insurance Act in 1870 and then a few organized efforts were made in life insurance sector in India. The First World War gave a boost to Indian business of life insurance. So many companies were formed to do business of insurance. One comprehensive legislation was passed on insurance by government for the first time in 1928. During the Second World War, so many new insurance companies came up. The government took many constructive steps to regulate the business of life insurance and ultimately nationalized the business of life insurance in 1956. Life insurance business was carried on by the only company in India. But now again government permitted the private sector to enter in this field. With this background, let us see the meaning of life insurance. Life insurance is a contract whereby the insured promises to pay a uniform rate of premium at fixed intervals of time against which the insurer agrees to pay a fixed amount on the happening of the event, which may be the death of the assured or the expiry of certain number of years. We will go to the definition of life insurance. According to Bunyan's law of life insurance, a contract of life assurance is that in which one party agrees to pay given sum on the happening of a particular event contingent upon the duration of human life in consideration of the immediate payment of a smaller sum or certain equivalent periodical payments by another. So, what are all the economic nature of life insurance? The life insurance is concerned with hazards that stand across the life of every person, that is dying prematurely, leaving dependent and that of living to old age without visible means of support. It gives family protection to protect the families from the economic hardships after the death of the breadwinner member of the family. It gives investment of savings. Savings provide the new source of income when permanent earning stops, and life assurance provide an immediate source of income for one's family on the death of an insured person prematurely. It gives additional way of earnings. It provides an insured additional earning by way of bonus and interest credited by the insurance company or insurer. It is helpful at the time of cessation of earnings. Life assurance is needed because when one ceases to earn money, insurer provides certain sum of money to the insured as per various terms of policies. Now, we will see the various characteristic features of life insurance. Life another contracts of insurance. The life insurance contract is also the outcome of an offer made by the insured and its acceptance by the insurer. Usually, contract of life insurance is made in writing. The insurance company agrees to pay a certain sum of money either on the death of the insured or on the maturity of the policy, whichever is earlier. The insured is under an obligation to pay periodically the amount of payment in form of premium till the death of insured or expiry of the period of policy, whichever is earlier. The contract of life insurance is not a contract of indemnity because the loss caused by the death cannot be calculated in money terms, nor money is a compensation for loss of one's life. Insurable interest must be present in the person insured at the time when the policy is taken in case of life insurance, which may or may not be present at the time of insured's death. life insurance extends the hand of protection to those who are left supportless and helps financially in case of death of the insured. It is also considered to be the best alternative for making savings. Life insurance covers certain other risks which are connected with the human life in addition to the risk of death. For example, in case of total and permanent disability or temporary disability and medical expenses, compulsory retirement or the economic death risk, etc., have also been covered under the purview of life insurance these days. It relieves the insured from the sword of domiciles, that is, various risks and uncertainties which may occur before or after the death of the insurer. This is the about characteristics of life insurance. Then we will move on to benefits. In a nutshell, benefits to buying life insurance today are: you will have ultimate peace of mind that when you pass, your family and loved ones will have a financial safety net. Life insurance will pay a lump sum benefit to fill the financial gaps. Payouts are generally tax free. You can increase or decrease the benefit of the policy in the future. There are types of life insurance that have a cash value. A portion of the paid premium is set aside and either accumulates interest or is invested in the market. You can borrow from that cash value or kept it as an end of life payout. Most policies provide an advance benefit without a waiting period to help cover immediate costs following the death. Now, we will discuss the advantages of life insurance in an elaborate manner. It acts as a superior saving plan. This is considered to be the best saving plan in comparison to other plans because it guarantees full protection against risk of death of the insured. In life insurance, on death of insured, the full sum assured is payable with bonus wherever applicable, whereas in other saving schemes only the amount saved with interest is payable. No other saving plan provides this kind of protection. It encourages saving habits. Life insurance encourages saving habits. Long-term savings can be made in a painless manner because of the easy installment facility built to the scheme. The insured person can pay premiums through monthly, quarterly, half-yearly or yearly installments. The employer is authorized by the employee to deduct insurance premium mostly and remit to the life insurance corporation and other insurance companies. Suitable for leasing loans. Life insurance policy can be given as security to raise the loan even for commercial purposes also. The loan can be raised without any delay on safe security of the policy. Even after an initial period payments, if the policy holder finds it difficult to continue with the payment of premium, he can surrender the policy for a surrender value amount with the life insurance corporation and other insurers. It is a protection against creditors. The maturity value of life insurance policy can be protected against the claims of creditors of the life assured by valid assignment of a policy. The policy holder can nominate a person to whom the policy money would be payable in the event of his death. It gives a tax relief. The income taxes available for amounts paid by way of premium for life insurance subject to the insurance tax rates in force. Assessees can avail themselves of provisions in the law for tax relief. In this manner, the assured is required to pay lower premium for his insurance than he would have to pay otherwise. It provides estate duty. Life insurance ensure the definite sum of money after the death of the insured without resorting to sale of assets at a loss on realization. So, it is the best way of making provision for payment of estate duty. It gives economic protection. Life insurance provides economic protection to the family members of the insured in case of his untimely death, who might be the sole breadwinner of the family. It reduces the sufferings of the families on happening of a contingent event. It is considered to be the most effective device for providing family security. It is the best investment element. In life insurance, the insured is required to pay the premium. The premium is a kind of investment. This premium is returned to the insured along with additional bonus amount after the expiry of the period of contract or date of death, whichever is earlier. Helpful to the government. Apart from the social role, it plays a relieving government of some of the burden of meeting financial security needs. Life insurance can assist economic development in general and the development of financial markets in particular, because they have thousands of policy holders. Insurance companies are able to amass quantities of funds that are important in supporting investment and the national economy. They thereby serve as financial intermediaries between investors and economic agents that lack sufficient financing, households, business, and in some cases even governments. The emergence of this new type of intermediaries with features different from those of banks with regard to the time frame of investment in particular makes a major contribution to the development of financial markets. In the developed countries, insurance companies are the largest institutional investors. Money when needed is provided. A suitable insurance plan or a combination of different plans can be taken out as life insurance to meet the specific needs that are likely to arise in future, such as children's education, start in life or marriage provision, etc. Loans are also granted to the policy holders subject to certain conditions for house building or for purchase of flats, etc. In this session, we discussed on the components of life insurance such as meaning, definition, nature, various characteristics and advantages of life insurance. Dear students, I like to highlight a point from our discussion is save for a rainy day. This saying teaches us to save while young and earn higher for the future. We will see principles of insurance in the next session. Have a good day.